Get ready to get your questions answered by financial advisors. Learn how to put more money back in your pockets regardless of where you're starting your financial journey with your host, Hannah Mitria. I'm super excited to have you on, Gabriel. You are with Falcon Wealth, Planning Made Simple, and just kind of share a little bit of your background and your story and how you got into it, and then what people need to know about Falcon Wealth.
Yeah, Falcon Wealth was founded in 2015. We really were trying to create a firm that can cater all aspects of wealth planning, wealth management, wealth accumulation, wealth retention. And we found the biggest focus on that is a holistic approach. And that's not just talking about investments. Investments is the easiest part of one's job. When you're fee-only non-commission, you don't get paid from selling one product to another. The focus is to increase our clients' net worth. Mm-hmm. And so with that, we looked at what's the biggest expenses to our clients. And we found over time that taxes were the biggest expenses, whether people knew it or not their mortgage payment, not anything like that, but taxes, because there's federal tax, there's state tax, except if you're in, states like Texas or Nevada, so on and so forth. And then there is still FICA tax, which is Social Security and Medicare as well. And let's not talk about also the property tax, which almost every state is subject to, and then sales tax, so on and so forth. So it's really just understanding your full tax situation and how to legally reduce it. And so that was really the core competency of the financial planning piece of what we do. And the holistic approach, obviously, you have high net worth individuals or business owners, there's liability reduction, there's ways of structuring corporations to reduce corporate tax, to reduce actually just overall tax benefits of having a corporation by controlling certain aspects of how you structure your company. And then, of course, just the last piece of estate planning, death tax. So, those are really the big focuses of us. I actually wrote something. I wasn't planning to share it here, but as I'm talking about all this tax, I wrote something I thought was kind of funny. I wrote this on an airplane coming back from New York. I said, okay, so I'm paying taxes. I said, let me get this straight. So I'm paying taxes on my wages to the federal and state government, then taxes for retirement benefits on my wages for later, and then paying sales tax to spend my own money, and then paying income tax on money that was already taxed, and property tax on real estate I bought with after-tax money. Then when I die, my kids will pay a death tax on money that I already paid taxes on. And then people hate me for doing everything that I can legally do to reduce taxes. So sometimes I'm like the bad guy because I help the rich get richer, but it's like, dude, like taxes are like the real deal.
Yeah. And I was listening to your podcast that you did a couple of weeks ago, and you talk about the left are thinking this, the right are thinking this. And the problem is we're not trying to evade taxes. That's not what we're trying to do. We are trying to make sure that we're only paying what's owed when we pay our taxes. And if that means we can minimize it as much as possible, why shouldn't we be doing that? Because we're business owners, and the more money we can keep means the more money we can put into the economy in other ways to benefit other companies, benefit other businesses, benefit employees. And so I am all about minimizing taxes in a legal way, not evading taxes.
You're absolutely right. And here's the thing, as a business owner, we're taking all the risk. There's a reason 90+% of the Americans are multimillionaires. And so because we're taking all that risk. So yes, you have to save that money, whether you're reinvesting it into the economy or you're reinvesting it in yourself in cash reserves, because cash is king as a business owner, or you're using it to hire more staff, increase marketing. No matter what you're doing, you're increasing the revenues of your organization, which does better the economy. Just that peaceful sleep at night that you can get as a business owner, I think is just ever changing. And when you can have the IRS, where you could save on taxes, where in essence, you do certain tax planning that can help you save tens of thousands of dollars, if not hundreds of thousands of dollars throughout your working career or more, by the way. I mean, that's life-changing. So when we help our small business clients or high net worth individuals in these concepts, I mean, it's who cares what you're charging for money management? Okay, you charge $20,000, $30,000 a year to manage my money, which is, whatever it may be. Well, you just saved me $40,000 to $50,000 a year in taxes. So frankly, it's not even they don't even ask, how are you going to invest my money? I mean, that's not even a question because the instant credibility is there. And the issue with our industry, or even I'll take it a step kind of further or off to the side with the tax community, as we have CPAs here at Falcon Wealth Planning, they're trained in compliance, not planning. They know, I mean, you meet with your accountant now, right? Or if you do extension, you have until September 15th, October 15th, depending on the structure of corporation. They're meeting with you now in 2022 for what happened in 2021. But a lot of the tax strategic things that had to be done by the end of the year. Mm-hmm. And you just can't, there is a separate profession for planning. A tax preparer that you meet with once or twice or a few times a year, that's a preparation. They do it for preparation. It's just two different worlds. They can't do it. They know they can't do it. So there's a space for tax planners in the industry.
Yeah, extremely. Because just like you said, the taxes you're doing right now are not for this year. You're not doing taxes for next year. You're doing the taxes for last year. And, a lot of people are just coming out of tax season, or, if they had an extension, they're now finishing those taxes, but they couldn't do anything for them. And so I know a lot of people ask, like, who should I be going to? And you kind of mentioned on there, like going to a planner. So should I be going to a CPA? Should I be going to a CFA? Like, where should I be going when I'm in this stage of, okay, I need to make sure my taxes are done correctly? Who do I go to?
Yeah, first step, and it took me a while to realize this as a business owner, and successful business owners realize this faster. Mm-hmm. And it is, you can't afford to be cheap.
Yeah.
You might, in our profession, we're professionals. You might want to get somebody fresh out of college, save, instead of paying somebody six figures, you can pay them half that. But then you realize, wow, they can't get business. Nobody trusts this person. They're not as knowledgeable. They don't have the experience. So you lose clients. So it's like, man, I saved $50,000 on salary, but I lost $500,000 and lost business.
Yeah.
I can't afford to be cheap. With that being said, a tax planner is the same thing. People make fun of Trump because he saved all this money. He avoided paying millions and billions of dollars in taxes. Well, because he had a tax planner, he has attorneys, he has many people around him. Only the mega rich can afford it. That's not true either. You can't afford to be cheap. And so you have a tax preparer. That's one thing. That tax preparer has to collaborate with the tax planner. Simple as that. So you might be paying a couple $1,000s for your tax preparer, assuming you're a business owner. You might have to pay also a few thousand for that tax planner as well. It costs $2,500 to $10,000 plus. But you're not going to pay $10,000 a year if they can't save you $20, $30, $50 plus $1,000 a year, right? I mean, it's logical. So really, I had somebody say this to me the other day, you charge $12,000. I was like, the way I look at it, we're charging you a negative $26,000.
Yeah.
I mean, I don't charge 12. It's negative 26. Mm-hmm. I'm saving you almost $40,000 a year. I'm not charging you anything.
Yep. I completely agree with that. Like, growing up, my father was always an entrepreneur and he always did his own taxes or TurboTax. And so like when I first got into business, of course, that's what I looked at too. And then very quickly I was like, no, we need to hire somebody to do this. And the first year we hired somebody, they saved us half of our taxes that first year. And so it's like, yeah, we may have had to pay them money, but they also saved us thousands of dollars by not doing our taxes ourselves. And I think, getting out of that mindset of saving the money, because just like you said, you can't afford to be cheap because that's costing you money.
It took us a while, just my wife and I, to like, when we go out to dinner, to not just get the chips and salsa that's free and to not just order waters. It like hit us during the pandemic, like we're going to be fine. Mm-hmm. So, but it's just so hard because you're constantly thinking of worst case scenario, and successful business owners have to do that. I mean, everybody else comes to a job and they get their paycheck. They go 9 to 5 and that's all they think about. Or business owners, it's not like that at all. And so it is a mentality shift to say, okay, I'm comfortable spending money to make money. And you still see that separate from successful firms. I don't care what they are. They could be the corner deli to an insurance company, to a chiropractor, to a dentist office, of spending some money on marketing. Mm-hmm. You should be able to get 2 to 3x return. Yeah. And it's crazy. You still don't see it. And in this, you're reinvesting in yourself. Mm-hmm. That's all this is. And it's just a recommendation that I make for everybody. And if nothing else, get that free consultation. Even if there's I know firms like us, we offer that free consultation, but even if other places out there charge $500 for a consultation, it's $500 and they may be able to find something that could save you money. And so I know some places have guarantees. If we can't find something that could help you, you don't have to pay us. And so I just do think for a business owner, you're, number one, never going to know anything. Number two, even if you do, it changes.
Yeah.
So I do recommend doing that minimum, ideally work with someone, but if not, once every few years.
Yeah. And let's talk about it real quick. Probably not real quick, but let's talk about how you mentioned, when you first got started, you're really looking at investments and that's how you make money. And then you realize, no, taxes actually is what's eating up the most of your money. And so we're about to roll into Q3. So what are some strategies we should be using to reduce our taxes looking into next year? Because, what we're doing right now, like you mentioned, is what we'll be dealing with next year, not what we're doing now dealing with last year. So what should we be doing in Q3 and Q4 to help reduce those strategies?
Yeah, great question. I would say there's a few things you look at. From a tax planner point of view that looks at everything, I would say something as simple as if you're charitably inclined, looking at your financial situation today, which means the income that you make today, and compare it what you think you'll make next year. And so you maybe want to pre-fund some charitable deductions this year. You can do that through something like through a donor advice fund, for example, where you can do that in advance. Depending on when your fiscal year ends, let's assume it's a December 31st fiscal year. But you might want to buy some bigger items for Section 179 or bonus depreciation, where you can write off the whole thing versus depreciating it out over 3, 5, 7+ years. So that could be very important for you to do. Okay. There are many different things that you could do from an investment front. If your investments have dropped in value, I would recommend 2 tax planning strategies. Both of them have to be done by December 31st. Number one is, if you are of age, 72 and above, doing a required minimum distribution while it's low. You think about this, you're taking money out of your IRA that you have to pay taxes on. You're taking more shares out. Now, why it's dropped, you're not selling it and then moving the money into cash. You're taking the shares out and moving it into a brokerage account. So if that TD, Schwab, Fidelity, wherever, you're just moving it internally to a brokerage. That rebound comes outside of the IRA. Why is that important? It's taxed lower than your ordinary income tax bracket. They have capital gains tax rates. Number 2 is, on that similar token, is doing a Roth conversion, depending on your tax situation. If you have $1 million or had $1 million in your IRA, and now it's only worth $800,000, I'm not telling you to convert $800,000. Then you'll pay $450,000 in taxes and say some bozo that was speaking to Hannah told me to do a tax Roth conversion. No, it's take a look at your tax situation, the bracket that you're in today, and maybe converting to that bracket, top of that bracket that you're in, and comparing it to other brackets that you have going forward. Because most business owners are on an upward trajectory of income. That's their goal. As capitalists, entrepreneurs, they want to keep growing their income. On the inverse side of that, if they see that being lowered because maybe they're the tail end of their working career, well, then maybe you save into a retirement account to get the write-off before the end of the year. And then when you retire and your income disappears, then you do the Roth conversion in early years of retirement. Because think about it. You put into an IRA or a solo 401k, a defined benefit plan, the profit sharing, whatever you want to call it, 50,000, you save 50 cents on the dollar. Let's say you're in this, let's just say 50 cents on the dollar. So now you put in 50,000, you save 25,000 in taxes. Great. But now you're going to pay tax on that later. Well, if the next year you're only in the 12% bracket, you can then take out that 50,000 and pay 6,000 in taxes. You got 25, you paid 6, you net ahead 19,000 on 50. Not too bad. You just created what is that? 38% tax alpha return by being tax strategic. They don't teach those in the books.
Definitely not. I was doing another podcast where we were talking about our IAs and like Roth and all that, and how the IRS is just taking so much money out of that. And it's something you mentioned in what you're writing on your way back from New York City was, death, you're going to pay taxes on. Your retirement, you're going to pay taxes on. So I almost look at it now that I've been learning more about it, it's like a murder mystery for taxes. They're trying to figure out how much money can they get when you die. And you're balancing this act to be able to create those different contributions and putting them in the right places to help minimize those taxes, because it's money earned and money you want to be able to pass down to your family and live off of for years to come. So being able to find those ways to save 38% or make 38% off an I can never say that right. RIA.
There's RIAs and IRAs.
Yes. They get all confusing. So, and I know you mentioned, so, looking at putting investments into stuff. And right now we have another client, or I have a client that is in real estate, and they're talking about how we're about to hit a recession. I just saw on the stock market today that Target stock is dropping down. And so a lot of people probably are in that fearful state a little bit of how like they shouldn't be spending money on things in the future because they're going to need that money. But also holding on to that money is going to create that tax burden for them next year. So what are some thoughts that you have on that, on, what they can be doing when they're in that predicament where they're seeing the possibility of a recession or something happening? And so they don't want to be out of that money and then be able to be like, oh man, well, I prepaid for the service and now I don't have the clients to cover it next year anyways. So what are some things that you have there?
I think as an entrepreneur, as a business owner, as just a person working, as just a human that works for a paycheck, you have to think to yourself, no matter what happens in a recession, a few things. Are we still going to eat food? Are we still going to be on the internet? And are we still going to pump our car with gas? I understand there's a limitation. People won't go to restaurants as much, so on and so forth. But as long as we believe that, companies and organizations and individuals and humans, we're survivors. We find a way to survive. And it's as simple as that. And there's a reason in all market cycles, rich get richer and poor get poorer. And so with that being said, this whole idea of a recession coming, I believe it, but I believe it in a different extent. We have inflation up over 15% over the past year and a half on track. And you need 2 quarters of negative GDP for that official recession. And normally by the time you're in the recession, we're already recovering of the recession because the stock market's a leading indicator. And my point of saying all of this is that we might be, I'll coin it, a phantom recession where yes, we may be in a recession, but because profits are higher in corporations, because them netting 1 billion 3 years ago is not the same as 1 billion now, they need to net 1.5 billion. So you might see on TV record profits, but that record profits doesn't have the same purchasing power as before. So yes, we may be entering into a recession potentially, but it may not actually be a recession because inflation will carry it over where it won't be a recession. So let's talk about recession. Like, what should you be doing? You need your money working for you no matter what. Yeah. And the stock market is the number one hedge against inflation. And that's the biggest issue. That's what people are concerned about. Yes, we have worries about Russia and Ukraine. And this has become like a geopolitical economic domino effect of now we're seeing shortages in almost everything. Everything. This is affecting now China and India, whether it's wheat, whether it's fertilizer, and these all will trickle down where we will see 30 to 40% increases in cost. But yet again, that will yield to fiscal policy, which is to more higher costs, which is inflation. Will that mean corporations will earn less? No, they're going to earn more. So stock market is the number one hedge against inflation. And so there is short-term punches in the face, but you need the stomach to survive it. And you have no other option. And real estate right now is not the best option with rising interest rates. That is affecting cap rates, and institutions has pulled out of the residential real estate market and even slowing down in areas like California and other expansion states. They're saying, no, those are high-risk areas and the Northeast. So my point is there is no safe place, and you have to always have your money working for you. And you can't just be right once. Oh, I'm going to pull out now. By the way, if you pull out now, you're too late. But let's just say you pulled out 6 months ago. You can't be right once. You have to be right twice, and then you have to get back in. And does it feel better now to get back into the market than it did 6 months ago? No, you don't feel better now. And so you can never try. Here's the problem with smart people. They make a lot of mistakes in financial markets because financial markets are illogical. Who would have thought the stock market in the middle of COVID in 2020 would have went up over 20+%? Who would have thought the stock market in 2021, still in COVID, goes up almost 30%? It's illogical. So stop being smart is my advice to everybody. And that includes myself. I tell people, you hire us not because we're smart. You hire us because we're disciplined. We buy when nobody wants to buy, and we sell when nobody wants to sell.
Yeah.
So stop being smart.
I downloaded one of the sheets on your page, and correct me if I'm wrong. I'm pretty sure part of it even mentioned how, like, when everybody else is being greedy, that's your time that you should be backing up and saving and being more cautious. And then the reverse, when everybody else is cautious, that's the time you should be being more aggressive and greedy towards those different things.
Yes, Hannah, that is perfectly said. And that is why it's important as you come towards the end of the quarter to relook at your portfolio. And you can't just look at quarterly rebalances because the markets move pretty quickly. Mm-hmm. You do have to look at systematic intra-quarter rebalancing of the portfolio. And what I said and what you re-explained of my greedy and fearful analogy is what rebalancing is. If the stock markets have gone up so much in 2021, take your profits off the table and reallocate it to those that have been suppressed, that didn't do as well. In essence, you're selling high and buying low. Mm-hmm. And you're doing that over and over and over again. And you're reducing your risk in that process. And it doesn't matter if it keeps dropping, you keep buying. Because, may I go back? That assumes you're investing in indices, mm-hmm. right? It didn't work well if you kept buying into Radio Shack.
Yeah, please don't.
Or Blockbuster, or Lehman Brothers, or Bear Stearns, or we can go on and on. So that it assumes indexes. So that's why I said investments is the easiest part of what we do, because we just choose the best indices and allocations that are out there. It's quite simple. We get market-like return. And oh, by the way, 98% of active managers, professional managers, so on and so forth, over a 30-year period, fail to beat the corresponding index. So heck, if you can't beat the index, just join the damn index.
One question that kind of comes off of that, because I would consider myself a very new investor into the market and things like that. And so one thing I'm always thinking about taxes and how that's going to affect when you pull that money out, because so many people don't realize, especially with crypto and how that all is going now, that they put money in quick and try to pull it out. And you mentioned Radio Shack. And I remember when Musk did something, made Radio Shack stock like jump up and then jump back down. And, people jumped in and jumped out. But now we're talking about capital gains tax, that short term. And so what advice or what strategies, and at the end of the day, like really when you're doing big investments, just go talk to Gabriel. But what advice would you give somebody that's listening on those short-term capital gains? If you're doing kind of those investments, are you going to get those same things when you're buying low, selling high in that short term to keep?
Not necessarily, because it's not going to really, well, there's two answers. Let's back up. First off, you should be having your money in a legitimate custodian, not like a Robinhood. And I'm comfortable saying that and targeting them. There's enough lawsuits on them to validate it. Where you can adjust your cost basis, sale technique. So that sounds fancy. Let me re-explain. They will choose the specific lots that you bought it in. Let's just say you put in $1,000 a month or $100 a month or $10,000 a month. They will strategically sell the ones with the highest basis, or to reduce the tax consequence. Mm-hmm. So that's number one, if you're worrying about the rebalancing piece of it. Yeah. And then eventually, naturally, through attrition, you will get long-term capital gains when you're doing something like that. Number two, if you were buying into a Radio Shack in that split second, you were the one of 10,000 people who made money. Yeah. You do those type of, I call them Vegas and bets, in your IRA account. Number one, I would rather lose money that's never been taxed. Mm-hmm. You got $1 million. If I'm going to lose 20%, which you probably will, at least Dalbar studies say you will, I would rather lose money in the IRA than my after-tax brokerage account. Mm-hmm. So because you're probably going to lose choosing individual stock, I'd rather lose it in an IRA. And if you just so happen to make a quick 20%, you don't pay taxes on IRA until you take it out.
So you take your money out and put it into an IRA.
Yeah, I would do those short-term day trading in IRAs.
Just because, especially short-term, the day trading, that's becoming very viral, popular thing all over the internet, but people don't realize all of these different things that come in the back end of it. And I will admit, I jumped into it at one point, just looking it out. And when I talk to people and I go like, well, what are the tax things? They actually say like, I can't share any tax information. You need to go find somebody else. Right.
And that's what we are. We are that tax advisor, right? So let's take it a bit further, because a lot of these people, the younger generation doing these type of things, they're doing like $1,000, $2,000. And you see some fools on Instagram saying I turned 2,000 into 77,000. It's really easy. Mm-hmm. My brother sent it to me all the time. I'm like, this can't be real. Like, this is so ridiculous. Nonetheless, most of these people, majority of these investors are $3,000 and less. Mm-hmm. My recommendation is to, if they're eligible, most of them are, to get a Roth IRA. Mm-hmm. Do those day trading in a Roth IRA. And here's where it gets funny. And this is where my peers will be annoyed with me is, on short-term capital gains, you can be taxed pretty high, depending on your situation. But let's say you're in the highest tax bracket. Short-term capital gains could be over 50%, depending on the state that you're in. So you make $1,000, half of it goes to the taxes. Mm-hmm. If you did it in a Roth IRA and you made a bunch of money in a Roth, the penalty is only 10%.
Okay. Yeah.
And you can take it out for many reasons. You can take it out for health reasons, education reasons, home purchase reasons, many different things. So a Roth could be your safe haven. That's if you think you're really smart and could make 20, 30% in a month.
Yeah. If you can turn that $1,000 into $27 trillion, I think what it comes out to. I've seen it before and I'm just like, I feel like if when people see the number, that alone should tell them it's not real. If we could all turn $1,000 into trillions of dollars in a month or even a year.
But see, this is the problem. Yeah. The problem is my biggest fear. I got interviewed on something and they asked what my biggest fear is. My biggest fear is 2020 and 2021, those past 2 years, they feel that investing is easy and they can't lose. And my fear is they've scarred a potential generation of millennials of thinking this is easy and they can't lose. And now they see a situation like this, like, forget this. I thought you're always supposed to make 20, 30% returns.
Yeah.
That was my fear. So here's where I'm going with that. You have a company like Hertz, okay, they declared bankruptcy and I'll call him an idiot on Reddit who's like, oh, you should go buy some. So so many people were buying a company going bankrupt that Hertz looked around and was like, look at these idiots buying Hertz. They reissued $1 billion worth of new shares. And
oh my gosh.
Idiots bought it.
Bankrupt cap.
Yeah, for a bankrupt company. So they're like, this is great. Here's where it gets more stupid, where the wrong people became right. So they were buying this thing at 50 cents a share. Well, what happened was they ended up being purchased by a private equity firm at a buyout at $8. These idiots, novice investors, made 16 times their investment.
Wow.
They ended up being right because they were so wrong. It pushed it to be right. I mean, you're seeing things that have never, ever happened. But so that is my fear of people trying to do this. I know we could have been on a tangent on it, but I say it's fun to do. I'm not saying not to do it, but just be comfortable with that type of investing, it going to zero, which is why I prefer you do it in an IRA account than a Roth, depending on your tax situation.
Yes, I agree. Be cautious if you do it, and we could totally go on a tangent about that all the time. But let's jump back over to taxes and kind of creating those, tax planning and reduction. So if you're a business, where can you look to kind of cut those costs to save money on taxes?
I think you probably have to look at just your overall salaries and profits of the company are probably important. And there is some combination that makes sense. And then, of course, the structure of the company, I think, is important. You want to make sure sometimes it makes sense to do a C corporation. Sometimes it makes sense to do LLC. Sometimes it makes sense to do an S corporation. Sometimes early on, it makes sense for a sole proprietorship, which is just on your Schedule C of your tax returns. No separate anything needed. So it really depends on, I guess, number one, how much revenues you have. Number two, what state you're in. Number three, what's your net profits? Number four, how many employees do you have? I think those probably are the first four key attributes of how you could save money. And once you know those four things as a tax planner, you'll probably have a follow-up, another 4 to 14 to 40 questions. And from there, I think it's just important to know, what strategies are available. And no matter what, I feel like there's always something. I mean, it's very rare we can't find anything that you can do. It could be something as simple as creating a retirement account, which in the state of California is now mandatory. for a business to have Oregon has done it for a while, but California and a few other states. So it's like, what type of retirement account? So it doesn't, most business owners would prefer to spend money on themselves versus their employees.
Mm-hmm.
It's just a natural thing. I'd rather feed myself, right? When you go on an airplane, put the mask on you before your kids. So yes. It's the same thing with business owners. So taking advantage of those and which plan to have is better. I see a lot of the time people saving all this money in a brokerage account. In a brokerage account, you have to worry about short-term and long-term taxes. We'll call that capital gains. Mm-hmm. You have to pay money on interest, and you got to pay money on dividends. So I see people saving so much money in a brokerage account. Part of me is like, why aren't you saving in a Roth or a solo Roth 401k? You pay no taxes on any of it. And so there's a lot of different, but that's just a few simple things that you can do to, help reduce in taxes.
And I know you mentioned like the different business types too. And, most companies start as probably an LLC or a sole proprietor and things like that. So should they be going to a tax planner or a financial planner to be able to help them navigate which one? Or is that something they should be going to even like an attorney for? Where would you recommend their first stop is to kind of figure out where they should be headed?
Not an attorney, an accountant. I would like to say a CPA, but I've just seen a lot of wrong advice from a CPA. You really have to look at tax planners, literally Google tax planners and interview 3 of them. And they have to be just tax planners. That's it. And so you want to see, sure, they may be a separate division that does taxes too. They want it in-house. I respect that. But tax planning has to be their core competency. And then you have to see, hey, this is my situation. Even if you have to pay for it, what would you recommend and how much would it save me? And if I was you, I would do that with either the one that instantly just like, wow, just enough. We get that a lot. But I typically recommend interview 3 of them. It might cost you 3 separate $500, but holy smokes, this is your future. Can't afford to be cheap. I'm pretty sure Trump interviewed more than one.
Yes, definitely.
So that's, Trump wasn't always Trump. Listen, I'm not a Trump yay, but he's always being bashed for the amount he saved on taxes. And a lot of his strategies are cost segregation and strategic depreciation. And, he's more of a real estate guy, but a lot of him is also structuring of corporations and how he pays himself, which is why he's a multi-billionaire and doesn't pay any money on taxes. By the way, Jeff Bezos did the same thing. One's conservative, one's liberal. And so, Amazon didn't pay money forever. And you can't bash on him because now look how great how much money Amazon pays in taxes. So these are key things our government tries to help you with by creating the proper strategy. The sophistication of our government is they make it so complicated where you don't know it. So much so where CPAs don't even know it. So that's I think I don't want to say murder mystery part of it, but that's the poetic, I don't want to say beauty, but the confusion.
So the labyrinth of taxes. I was going to say the same thing. There's people that don't like Trump. But if we look at some of these people that are really rich, like Jeff Bezos, Elon Musk, Trump, all of them are spending money, and goes back to your thing where you said, you can't afford to be cheap. And so they're not being cheap in that sense. They're going out there, they're finding their certified tax planner and the tax experts to make it so they don't have to pay taxes, and they're navigating that tax maze to find the doors that make the most sense for them, so that, legally they didn't pay taxes, but that was illegally. They still didn't evade them. They just legally were able to find those ways that the government put in place for us to be able to save money in those areas.
I have a lot of respect for Bill and Melinda Gates Foundation and all they've donated. Same thing with Warren Buffett and his. And they've given multiple billions of dollars. But I'm telling you, if the tax laws were different, people would not be as charitably inclined. And it's as simple as that. Your money goes 3 places. Your job, Hannah, is to decide where your money goes. And you have 2 out of 3 selections. Okay. Number 1, it goes in your pocket. Or to your heirs if you're no longer here. Yeah. Number 2 goes to charity. Number 3 goes to the IRS. You choose 2 of the 3.
Yeah.
Most people
I can
who choose themselves and charity. And other people like the Clinton Foundation, they have their own families running their foundations of many millions of dollars, and nothing is wrong with that. And so whether you're for or against Clinton, I can care less. I'm just giving you examples of people. The Warren Buffett's foundation. And you need outside family members too for boards. And sure enough, you have Bill on Buffett's foundation and Buffett on Bill's, and they're buddies and give to each other. And it's just the world that we live in. Be strategic on everything. I always say, if there's a will, there's a way. And if depending on the amount of money that you have, it may make sense to create your own foundation as well, or at least nonprofit.
And then we'll end this kind of with one final question of just, if there was one thing that if the listeners didn't take any other thing but this thing, what's the most important thing they should be looking at when they're tax planning?
Oh, what's a good question. What's the one thing they should look at when they're doing tax planning?
What should they do? Yeah.
Pay yourself first. I mean, don't ever think you need to just spend something to get a write-off. It really annoys me when I hear that, when their accountant said, oh, no, you're paying too much. Go buy something for $50,000. Like, that just seems stupid to me. Because even if you didn't, you still probably keep 70% of it versus a truck you don't need. So pay yourself first. I know a lot of people reinvest in the company and they don't, but paying yourself first is important. And try not to pay yourself while the company's losing money. That doesn't make sense either. But still, pay yourself first and don't just frivolously buy things because they're a write-off.
Awesome. And then, Gabriel, tell people how they can reach out to you, how to connect with Falcon Wealth, and what you offer for them.
We have a team of over 30 individuals here. We have many CFPs, CPAs, attorneys, you name it. We do everything here in-house. We cater all across the country. So we're one of the larger RIAs, registered investment advisors in the country. We do offer a free assessment for you guys. So we'll give you 1 to 2 meetings, 1 to 2 hours of our time at no cost. And that really is to show our value to you. And we're not going to hold back and say, we're not going to tell you what we found unless you hire us. No. We're going to give it to you. We're one of the good guys in this industry. But you can go to our website, falconwealthplanning.com. That's falconwealthplanning.com or falconwp.com for short, or just give us a call at 855-963-2526. That's 855-96-FALCON, like the bird. And we'll be happy to work with you. We're very great on Zoom. We have many offices all across the country that may work as well, but we'd love the opportunity to serve you and really show our value. We've been recognized through multiple industry publications recently as we've been getting on the map and growing over 50% year over year, just on the uniqueness of what we do. And so we'd love that opportunity to show it off to you.
Awesome. And I know that we talked prior, and so I just want to make sure everybody knows that they are a fiduciary company. They are a fee for service only. They're not getting a commission off your investments. So when you go to Falcon, they're actually looking at what can they do best for you, not what can they do best that makes them the most money. They're really your financial quarterback. So make sure you give them a call. Like you said, interview like 3 people, make him one of the people you interview to kind of understand where you need to be going when you start your financial journey and find a way to tax plan. So, all right, awesome. Well, thank you, Gabriel, so much for joining us. And that's it there.
No, I appreciate it. That was great.
Thank you for joining us this week on the Virtual U.S. Financial Advisor Podcast. Subscribe to the show on Apple Podcasts, Spotify, Stitcher, or via RSS so you'll never miss an episode. We'd love a rating on iTunes, or better yet, tell a friend about the show, which will help us grow as well. If you want to learn from any of our financial advisors, head over to our website, virtualusfinancialadvisor.com, to learn more about each financial advisor and connect with them personally. Be sure to tune in next week to get more advice from the expert financial advisors. See you on the next episode.